In this video, we're going to walk through the adjusting journal entries for Dina's decorating. Recall, this is an extension of our journal entries that we recorded in Chapter 2 for balance sheet transactions, Chapter 3 for income statement transactions, and now we're recording the adjusting journal entries required to prepare an adjusted trial balance, and finally, our financial statements. Let's go ahead and take a look at our transactions. Before we do that, though, recall that adjusting journal entries always involve what? One balance sheet account and one income statement account. All right, transaction A. Dina's decorating had $1,800 of supplies on hand on December 31st, 2020. And when counting the supplies on December 31st, Dina found that she only had $800 worth of supplies on hand. So again, the cost of the supplies was originally capitalized, which means recorded as an asset, $1,800 in supplies. The matching principle says we record costs as an expense in the period they generate revenues. We've used some of the supplies in the current period to run our business to generate revenues. So now we have to record an entry to reduce the asset, supplies, and record supply expense. So again, we've got $1,800 of supplies on our books, but our account shows only $800 on hand. So we want that ending balance in supplies to be $800. This requires a $1,000 credit to supplies, and of course the other half of the entry will be a $1,000 debit to supply expense. In terms of our journal entry, we've got a $1,000 debit to supply expense and a $1,000 credit to supplies to reduce that asset. Transaction B. Dana had paid $12,000 for 6 months rent on November 1, 2020. As of December 31st, 2 months rent, of course, had expired. That would be November and December. So we paid $12,000 for 6 months. That's $2,000 per month. And again, we're told that originally we had capitalized it, which meant we recorded it as an asset. Now, since November and December have gone by, we need to reduce the rent by $2,000 times 2 months. That would be $4,000. So we're going to record $4,000 in rent expense and reduce our asset, prepaid rent, by that same $4,000. Of course, that leaves us with an ending balance in prepaid rent of $8,000, which is perfect because we still have rent for the months of January, February, March, and April. So 4 months at $2,000 a month. We have an asset at year end of $8,000. Let's go ahead and take a look at transaction C. Dina had paid $6,000 for 1 year's worth of insurance on June 1, 2020. This is similar to our prepaid rent. Our prepaid insurance was originally capitalized, which of course means recorded as an asset. So $6,000 as an asset for prepaid insurance. And our matching principle says we recognize a cost as an expense in the period it generates revenue. So we've had insurance coverage for the last 7 months. So 7 months of insurance has expired. $6,000 for a year means $500 a month. So we now need to record 7 months worth of insurance expense. So $3,500 in insurance expense and reduce our prepaid insurance by that same $3,500. Which leaves us with $2,500 in prepaid insurance, which is again perfect because $500 a month, we still have coverage for January, February, March, April, and May, 5 months in the coming year. So we've recorded $3,500 of insurance expense in 2020, and we have $2,500 of insurance expense left to record in 2021. So our journal entry is a $3,500 debit to insurance expense and a $3,500 credit to prepaid insurance. Item D. The company had acquired equipment costing $40,000 on January 1, 2020. And we're told the depreciation expense on this equipment is calculated as $2,000 for the year 2020. Again, this is similar to prepaid expenses, our prepaid insurance, our prepaid rent. Our equipment was originally capitalized, again, recorded as an asset. The matching principle says we recognize a cost, in other words, record an expense in the period we use it to generate revenues. So we're going to spread the cost of this equipment over its estimated useful life, which in this case happens to be 20 years. So if we take our $40,000 divide it by 20 years, we're going to recognize depreciation expense of $2,000 each year. Now, one thing you're going to notice, we're going to record $2,000 in depreciation expense, but rather than directly reducing the equipment, we're instead going to credit a contra account called accumulated depreciation. So we debit depreciation expense $2,000 and we credit accumulated depreciation for $2,000. And again, in terms of our journal entries, our debit depreciation expense will reduce our net income and retained earnings, and our credit to accumulated depreciation will reduce assets. All right, let's take a look at transaction E. On December 1, the company had sold $5,000 in gift certificates for decorating services to a customer. On December 31st, the accountant received an envelope containing $400 worth of redeemed gift certificates, and they've not yet been recorded in our company's books. So when we sold the gift certificates, we had not yet provided a service. We had an obligation to provide $500 of services to our customers. So we recorded a liability. Our journal entry would have been a debit to cash for $5,000 and, of course, a credit to unearned revenue, a liability for $500. Now that we've provided $400 worth of services to customers, revenue recognition rule says that we get to record $400 in revenues. Again, doesn't matter when we get the cash, it matters when we perform the service. And we've performed $400 worth of services. So we will credit revenues for $400. And of course, adjusting entries always involve what? One balance sheet account and one income statement account. So we've increased revenues and we need to decrease unearned revenues. We've reduced our liabilities. We now only owe our customers $100 worth of decorating services. So our journal entry is a debit to unearned revenues to reduce the liabilities, and a $400 credit to service revenue to record our revenue. F, the company had invested $20,000 in a certificate of deposit that's going to yield 12% interest at the end of 1 year. Pretty crazy interest rate. That ain't happening these days. But we bought that CD on June 30th. So over the past 6 months, we've earned interest on our certificate of deposit. We actually won't receive the interest until the CD matures on June 30th, 2021. But under accrual basis accounting, it doesn't matter when we get paid, that is, receive the cash. We record the revenue in the period we earn it. And we've earned a half year or 6 months worth of interest. So we take our 12% interest rate, and by the way, interest rates are always annual interest rates unless otherwise stated, multiply it by 20,000, and we would have gotten $2,400 in interest for the full year. Well, half of that, or 6 months, would be $1,200. So we're going to record $1,200 in interest revenue. We're not getting the cash today, but we're going to record another kind of asset called interest receivable, $1,200. Our journal entry then is a debit to interest receivables, an asset for $1,200, and a credit to interest revenue for $1,200. Let's take a look at transaction G. The company had borrowed, using a note from a bank, $30,000 on January 1, due with all interest the following June 30th, 2021. So it's an 18-month note, and the note requires interest at 10%. One of the first things, again, remind you of is that whenever we see an interest rate, in this case 10%, that's an annual interest rate. Even though the note is for 18 months, it's 10% every 12 months. And again, we aren't going to have to pay the interest until 2021, but under accrual basis accounting, it doesn't matter when we pay the cash, we record the cost in the period that we incur the expense. So the matching principle, again, record cost as an expense in the period they help us generate revenues. Over the past year, we've used that $30,000 to fund our business, to meet payroll, pay utilities, buy equipment. So we need to record interest expense in the current period. We're going to record 12 months of interest expense and record a liability of interest payable. So the face amount of the note was $30,000. A 10% annual interest rate means that interest for the full year is $3,000. So we owe $3,000 of interest for that period from January 1, 2020 to December 31, 2020. Again, we're not going to pay it till June, but we have a liability and need to record an expense. So we will record $3,000 in interest expense and $3,000 in interest payable. We record that interest expense with a debit interest expense for $3,000. And again, that will reduce net income and reduce retained earnings. And we've got our $3,000 credit to interest payable. H, the company has calculated its income tax, or at least we probably haven't calculated yet, but we estimated it's going to be $26,110 for the year ended December 31, 2020. Again, we're not going to actually owe this to the IRS until April 15th, 2021, but the tax is for income or profits we earned in 2020. And the matching principle says we have to record a cost as an expense in the period it generates revenues. So we earned the profit in 2020, we need to record the related tax expense in 2020. And of course, a tax liability at year end as well. So we will debit tax expense for $26,110 and credit taxes payable for $26,110. We record expenses with debits to income tax expense, and we'll record that liability with a credit to taxes payable for $26,110. Finally, let's take a look at our last journal entry. Dividends are not an expense, so our matching principle does not apply here. But since we've declared a dividend and made a promise to pay in 2020, we need to make sure we record a liability. We probably would have recorded this entry back on the declaration date on December 15th. So what are we told? On December 15th, the company declares a $750 dividend payable on January 15, 2021, and didn't record the entry. So again, as soon as we declare that dividend, it becomes a liability of the company. So we're going to need to record dividends as well as dividends payable. Our dividends, recall, will do what? They reduce retained earnings, and we've got our liability. So in terms of our accounting equation, we debit dividends, which will reduce retained earnings and decrease equity, and we recorded our dividends payable with a credit, which will increase our liabilities, and our accounting statement will balance. Again, this isn't typically an adjusting entry, because an adjusting entry involves one balance sheet account and one income statement account. Dividends are not an expense. They are a distribution of earnings to the shareholders. They appear on the statement of retained earnings.